Look, I wanted to talk briefly about that sector note Tanya mentioned, covering AGL, Origin, Genex and Delorean. So we've seen a rally in electricity futures in Queensland and New South Wales, which has been, I think, behind the rally in the share prices of both AGL and Origin. So I'm not sure how many people were aware of it, but Queensland had a very tight electricity market last week with a number of coal units down for maintenance during the recent heat wave. So despite generally milder summer temperatures, that event was enough to push quarterly prices in Queensland up to $150 a megawatt hour and New South Wales up to $80. So that probably won't mean a great deal for earnings for the large caps this year, as they tend to fully hedge their positions a year in advance. What it points to, though, is an earnings recovery in FY23 for the large caps, particularly for AGL. So this is what, as I mentioned, I think has been driving the share price rally for AGL as the market's gotten more comfortable that we've seen a bottom for earnings. The share price has bounced from its low of about $5.10 in mid-November up to the $7 price range we've seen more recently. So I've upgraded my FY23 earnings forecast significantly on the stronger earnings outlook for AGL in the next couple of years. Remember that AGL is very leveraged to the electricity price. It's got some of the cheapest coal in the market because of its long-term New South Wales contracts and its brown coal mine in Victoria, as well as a sizable renewable energy contract portfolio. So despite my optimistic view for FY23 and 24 earnings, though, I haven't moved my valuation significantly as the long-term headwinds facing the sector and the company in particular have, if anything, gotten stronger. The electricity market operator releases an annual update on its forecasts of the long-term forecast of the electricity market, and it's forecasting that major increases in renewable energy volumes in the next 4 or 5 years, which I think is going to force out a lot of coal generation. I think the stronger conditions for baseload generation that we're seeing at the moment is probably only a temporary reprieve. So in light of that, I'm retaining my hold rating. So I suggest that if you've had clients that have hung in there through the share price weakness last year, it might be a good time to position them to look for a decent exit opportunity. The company reports its results tomorrow, where I expect to see more confidence around the demerger plans. There was some speculation about the need for capital raising given the tight balance sheet. However, I think the better outlook for FY23 could provide some optimism there that some of the pressure might be off and might drive a bit of a smaller share price rally in the short term. But as I said, I see that more as an exit opportunity rather than a continuation of that, a strong continuation of that recent rally. On Origin, I've also upgraded my price target there on the stronger outlook for FY23-24 energy markets earnings, but it's less dramatic than the change in AGL. Because Origin is a more diversified business with its LNG exposure and less fixed electricity positions. And look, I know I sound a bit like a broken record here, but the flexibility of Origin's generation gives me confidence that it can take advantage of short-term volatility while having less downside from fixed positions if there is another slump in energy prices. For example, in the first half of 22, I estimate that Origin's generation revenue, its pool revenue, was 23% higher than PCP, but with about 20% less energy generated. And the gas plants that Origin has were a key factor in driving that outcome, being able to ramp up when the prices were there and then shut down when the weaker conditions returned. And so that really shows me the benefit of having that flexible position in case markets turn quickly to the upside and can also, as we've seen in the last couple of years, quite quickly slump as well. So I've lifted my price target 6% on the stronger expected outlook for energy markets, and I've increased my expected dividend yield to 4%. The reason for that is the very strong cash flows coming from APLNG in combination with the repaired balance sheet, with some of that sell down of some of its position in APLNG. The better energy markets outlook, and I think that will give management confidence to be able to pay a solid dividend. That means there's potential 12-month TSR of 12% in my numbers, and I've retained my ad rating. Just quickly on Genex and Delorean, no changes to forecast, but I just wanted to quickly mention that with all the volatility that's happening in the Queensland electricity market, the conditions are very strong for the Bouldercombe battery project, which is heading towards FID very soon. Genex is structuring that project so that we'll participate in any upside from volatile energy prices or from grid services. So unlike the hydro project where it's all fully contracted, Genex should participate in any upside. And there's a number of battery projects that were installed in South Australia and Victoria. They're able to repay their capital outlay within a few years by being online and available at a time of electricity market volatility. And we've seen a few of those instances in Queensland recently. So ad maintained, along with the price target of 34 cents per share. And finally, on DeLorean, it's worth noting there's some updated regulatory changes coming through that will recognise biomethane with a form of carbon credits known as ACCUs. The price of those credits has approximately doubled in the last, say, 6 months to a year, as the market is anticipating, in my view, that those credits will become more important as the push to decarbonise the economy intensifies. Still well short of parity with the European carbon prices, though, so there is upside if there ever is a drive to have a global carbon market. What that means for DeLorean is that I would expect a lot more interest from third parties for those gas plants, and also the economics of their own projects obviously will improve as well. I would like to see them develop a longer track record, though, of delivery and what has been a volatile market for capital projects recently before adjusting price targets and forecasts. But we should be getting an update from them on progress on their projects in late February with the financial result. That's it for me. Happy to take questions or leave it for Noxie.